Hey y'all, we are headed to the end of October 2023, and so I wanted to give y'all an update what's going on the local real estate market as well as the national scale. So let's take a look at Seattle. This chart was specifically from the beginning of October, and it takes into account the last 15 weeks. So as you can see, the inventory remains kind of steady, right? It's just up less than 1%. And pendings, this is homes that have gone into contract, buyers and sellers have mutually agreed, down almost 15%, and sold are down 26%. So, what this means is that the market is quite cool right now. Of course, we experience general market seasonality, but we're also seeing that a lot of buyers are sitting on the sidelines because interest rates are above 7.5% with no end in sight, right? We might not see this relax until maybe spring of next year. We don't know for sure. Fannie Mae, one of the two largest interest rate aggregates for the United States, predicts that it won't be until 2025 where interest rates will be closer to 4.5 to 5%. So let's take a look now at King County as a whole. You can see inventory amount of homes available is about the same as Seattle, up 0.6%. Pendings are generally down 12.7, and solds are way down at 33%. You can see on the east side, everything is down. Inventory is down, mutual contracts are down, and sold properties are down. Pierce County, inventory slightly up, pendings are slightly up, and the solds are way, way, way down, 40.5% down. That's a huge drop off. And then you can see Snohomish County, pretty similar to Pierce County in terms of the amount of solds. So let's take a look now at the let's take a look now at the macro scale. So these charts are very, very interesting. And I want y'all to have this information available rather than just the headlines that we see in the news, right? Because they're not always fully accurate and they're always, a little bit of hyperbole going on. So I want to arm you with the real information. So as you can see, this is from 2000. So last 23 years, this is the amount of homes that are available across the United States during the foreclosure crisis of about 2007, 2008. You can see that home inventory really peaked. Now, when we had COVID recently, obviously the supply chain was hit pretty hard. Steel prices were up, lumber prices were up, and builders stopped building as much as we need. Now, this is on a national scale, and as you know, real estate is hyper local, right? People are not going to stop moving to Seattle and Bellevue anytime soon. We're projected to have continued growth for at least the next 15 years, especially with all of the tech and software that's here. Obviously, we have Amazon, we have Meta, we have Microsoft, and we have a lot of blue collar companies as well, such as Weyerhaeuser. And so we're anticipating that the demand will continue to be high. And right now, inventory is low. To give you an idea, on a national scale, a balanced market is about 6 months of inventory. So if all buyers started buying homes and no new homes came on market, it would take about 6 months for all of them to go away. In today's market, we have somewhere around 1.5 months of inventory. So general supply and demand rules say that the homes will continue to appreciate over time, given the fact that a lot of buyers want to buy here and inventory remains low. So let's see about national rent. As you can see, since 1984, rents continue to go up and up, even during the foreclosure crisis, it plateaued for a time and then continued to go up and up. Landlords aren't going to all of a sudden say, hey, we're going to make less money. So some of y'all watching this video are renting, and some of y'all are currently owning a home. What we know is that renting is not a good financial strategy long term. We say that it's 100% inflation basically, and there are studies that show that homeowners' financial net worth is somewhere around 40 times higher than a renter's, and part of that is because rent continues to go up. We're not building any of our own equity when we're renting, and we're unfortunately building the equity of someone else. Now, this is the year-over-year United States appreciation rate since 1990. By the way, that's the year I was born. So as you can see, over the last 32, 33 years, there's only been 4 years of negative appreciation. Now, what I would recommend when we're looking at real estate is to look on the long term. Let's say that you bought in 2005 and there was a subprime bubble and people started lending to folks that did not have any credit or income or assets. And then this happens, foreclosure crisis. People couldn't pay their mortgages. And then all of a sudden over here, people are really buying at a discount. Say you bought here, and then all of a sudden you look on, I don't think Redfin and Zillow existed at the time, but let's pretend that they looked on Redfin and Zillow and they saw their house value dropped by 50%. Well, if that ever happens, you don't want to sell when it's down. You live in it. And that's the difference. One of the main differences between the asset class of real estate versus the asset class of, say, stocks. You cannot live in a stock or a bond, but you can live in the real estate that you own. So like I said, I would not recommend that you sell if it ever goes down like this again, and bank on the fact that over time, the appreciation is fantastic. And we're not talking about, like I said, a $1,000 Apple stock that goes up by 5%. We're talking about 500,000 or $1 million or more property going up by 5% is a lot different. And there's also a lot of many tax benefits that you can have by owning real estate as well. That being said, this chart is pretty striking to me. So you might wonder, okay, what about Seattle specifically? For single family homes, we average over the last 100 years an average year-over-year appreciation rate of about 5%. So I bring this all up to let y'all know what the situation is. We have low inventory, we have a low competition, we have higher interest rates, and appreciation is about to take another restart because the last year or so, there's been a market correction of prices. So long story short, there are opportunities if you're looking to invest. There are opportunities if you're looking for a primary residence. So you might ask yourself, well, what about these interest rates? They're too high. Well, guess what? The sellers that are selling right now, they really need to sell. So they are more ready to come into the boxing ring, into the negotiating table, to talk about them paying your closing costs and, or more importantly, them paying down your interest rate, whether permanently or temporarily. We're seeing this left and right. All the lenders on the market have these products available where you can buy down the interest rate. And I would love to help you negotiate those interest rates down. I hope you found these charts useful. I will upload them to this email. I hope you have a great rest of your day. Take care.